It is such a nice sunny day. What perfect weather to enjoy a nice and relaxing day at the beach. What shall we do after our swim stash? How about a game of netball followed by a massage? We can build a nice sandcastle later on too. We have so many things to plan for. Just then, umbrellas. Get your umbrellas here, exclaimed the Walter the Waiter Walrus. Sure, one umbrella please. Soon after purchasing the umbrella, the Walter the Waiter Walrus left. Uh-oh. As we were enjoying our well-deserved day out at the beach, suddenly the weather began to change and soon it started raining. Quick, Stash! We need to find shelter. Looks like our plan for the day is ruined by the rain. But don't worry, Stash. Luckily, I bought this umbrella from the Walter the Waiter Walrus. It's not very big, and we won't know how long the rain will last or if it will ever stop. But at least we have this shelter to keep us comfortable from the rain. As we huddled together under the umbrella, we were thankful that our shelter was just large enough to keep both of us dry. Hello everyone, and welcome back to our channel. In today's lesson, we will understand the major types of insurance that young adults need to be aware of, exclaimed Professor Shelby. These include death, total permanent disability, or TPD, critical illness, or CI, hospitalization, and integrated shield plans for Singaporeans. Let's get started. There are mainly two types of life insurance in the market. The first type is term insurance, which provides coverage over a specific period against death. After the term ends, the protection ceases. The second type is known as whole life insurance, which covers the insured person for their life. Monies will be paid out to the insured's beneficiaries upon the insured's passing. The cost to purchase insurance, known as the premium, is cheaper for term insurance than for whole life. Let's now learn how we can build a plan to suit our own needs by strategically combining these two plans. Stash is 25 years old today. He lives in a nice home with Mama Squirrel, but he still has a home mortgage of 100 acorns to be paid over 10 years. Right now, he is earning 20 acorns a year. Every year he uses 10 acorns to pay for mortgage, and the other 10 to take care of Mama Squirrel. First, Stash purchases a whole life insurance. He pays a premium of 10 acorns to be insured 100 acorns for the rest of his life. Next, Stash purchases a term insurance. He only needs to pay a premium of 1 acorn to be insured 100 acorns for a term of 10 years. From age 25 to 35 years, Stash's liability is on his home, worth 100 acorns. Should Stash have to leave one day and bid his last goodbye to Mama Squirrel, he ensures Mama Squirrel is taken care of. This is because Mama Squirrel would receive a total of 200 acorns, 100 from the term insurance, and 100 from whole life. The 100 acorns from the term insurance pays off the debt for the home mortgage, so that Mama Squirrel gets to keep the home. Next, even though Stash is no longer around to personally give 10 acorns to Mama Squirrel every year, the other 100 acorns received from the whole life portion ensures Mama Squirrel will also be able to live comfortably for at least the next 10 years. Now let's look at Stash's situation from age 35 years onwards. Stash's home would have been paid for. As such, he would also not need the protection from the term insurance anymore. Similarly, should he have to say his final goodbye at any time from age 35 years, he guarantees that Mama Squirrel will still receive 100 acorns to last her comfortably over 10 years. It's trivia time! Most whole life insurances offer flexibility in their plans. For example, Stash may choose to pay his premiums in a lump sum at the start, or spread his payments over 10 years or more. Stash may also adjust the coverage amount needed. Speak to your financial advisor for the recommended coverage needed. If Stash wishes to save even more acorns, he may buy a decreasing term insurance instead. This is a cheaper option because as time passes over 10 years, Stash's home mortgage liability would also reduce as more of his home is paid for over the years. Similarly, the protection needed will also decrease, and Stash will only have to pay the corresponding reduced premium for the reduced protection. You may have different priorities at different stages in life. As the circumstances in your life change, such as when a new home is bought, or after the birth of a child, and so on, your financial protection needs are likely to change too. It is important to consult your financial advisor regularly to ensure your loved ones are adequately protected. The next type of protection we need to consider is critical illness coverage. This type of insurance covers against severe illnesses such as cancer, heart disease, stroke, and so on. As of 2021, the number one cause of death worldwide is heart disease. In Singapore, this accounts for about 21% of all deaths that year. In contrast, the number one cause of death in Singapore is cancer, which accounts for 26.4% of deaths in the year 2021. Did you know? The estimated cost of early-stage cancer treatment can start from a few $1,000s to beyond $200,000 a year for late-stage. It is therefore important to go for regular checkups to ensure cancer is detected and treated early. Critical illness insurance can be bought as a standalone, similar to term insurance, which offers protection over a fixed period only, or as rider, which is an add-on when purchasing a whole life insurance, to protect against critical illness for a lifetime. Do note that most standalone critical illness insurance will not be able to accept applications beyond certain ages. It is therefore advised to protect yourself from critical illness while you are in good health or before you are too old. Next, let us understand hospital insurance. This covers many types of expenses incurred during inpatient stays, including costs due to critical illness. Some plans may also cover outpatient treatments and post-hospitalization expenses. In Singapore, the most common type of hospital insurance is the MediShield Life Plan, which is a compulsory insurance scheme for every Singaporean resident, paid via the resident's CPF MediSave account. However, do note that this is a basic plan that only provides the lowest tier accommodation, which is a Type C class ward, and will also require the insured to top up monies in the form of deductibles and co-insurance. For example, Stash is hospitalized. His total bill costs 11 acorns. The deductible is 1 acorn, meaning he has to pay the first acorn regardless of the bill amount. Next, the remaining co-insurance is 10%, and Stash additionally pays 10% of the remaining bill, which is 10% multiplied by 10 acorns. This adds up to 1 acorn to be paid for every 9 acorns utilized under insurance. As such, Stash will pay a total of 1 acorn for deductible and 1 acorn for co-insurance, which adds up to 2 acorns. The remaining 9 acorns will be covered by his hospital insurance. If Stash wishes to reduce his deductibles and co-payment, or upgrade his accommodation to a Class B shared air-conditioned ward, Class A private ward, or even have unlimited access to private hospitals, he may opt to upgrade his MediShield Life Plan to an integrated shield plan, which is offered by many insurance companies in Singapore. Most of the premiums can also be paid via CPF MediSave account. By combining hospitalization insurance with a critical illness coverage, Stash will be well protected against CI. His hospital insurance will cover the expensive hospital treatments and accommodation, while the lump sum from the CI coverage will allow him to pay off his mortgage and continue to provide for Mama Squirrel for a long time while he recovers and is unable to work. The final insurance that we need to understand is total permanent disability. This is defined as the inability to perform any 3 out of the 6 activities of daily living, or ADLs, which include washing, dressing, feeding, toileting, walking, and transferring. If this event occurs, the insured will receive a monthly payout for life to cover his redundancy and possibly hire a helper to assist him. In Singapore, all residents born in the year 1980 and after are automatically enrolled into CareShield Life when they turn 30 years, and premiums are paid using their CPF MediSave account. If Stash wishes to upgrade his plan to increase the payouts received in the event of disability, or make it easier to receive payouts by lowering the condition from having to fulfill 3 to just 2 out of the 6 ADLs instead, he may do so by purchasing a suitable plan from the various insurance providers in Singapore. Premiums for these upgrades can also be paid via CPF MediSave. Finally, we have come to the end of today's lesson, exclaimed Professor Shelby. But before we dismiss class today, allow me to share one final strategic advice with you, young squirrel. While TPD and hospital insurance can be paid by CPF MediSave, premiums for whole life insurance are usually paid using cash only, and this amount typically costs $250 a month as a start. As such, it is important to build up your first $50,000 in savings aggressively. Why? Because if you recall in the previous episode on investments, $50,000 will allow the investor to receive approximately $250 in passive income every month. As such, once the goal of earning passive income from $50,000 is reached, you will basically be able to insure yourself for free. You will then be able to focus on using your hard-earned salary for other things in life. Please click on the link in the description if you'd like to recap the last lesson. Alright, and that's a wrap, class. We hope you enjoyed today's lesson. Join us again in the next episode where we will look at how to analyze the benefit illustration, which is an important insurance document. It is important to be able to interpret this document because all financial advisors earn a commission from selling insurance, and it may be in their interest to over-insure you. While there are many reputable financial advisors who genuinely care about their clients, it is essential to arm yourself with a solid foundational knowledge so you can become an empowered consumer who is able to ask the right questions and establish if the recommendations presented to you are genuinely in the interest of your financial well-being. Remember, your financial well-being is priority. Until next time, stay safe.